everybody, and welcome to the Trader Newsroom. The big question on everybody's mind is, has the market top been put in? It is January of 2024, and we had some great news out of Apple today, and Apple was upgraded, as well as obviously the technology sector is continuing to look higher. A little bit of the 10-year is also moving to the upside, so there might be some trouble on the horizon as far as interest rate expectations. My name is Michael DeJoy. I'm the Director of Educational Services here at Trader, and I'm joined by my co-host Jill Molandrino from the NASDAQ market site in New York. Jill, how are you today?
Doing well, Mike. We are in, I don't know if you could see because of the lights, but you've been here before, our NASDAQ 100 museum. You can see Apple, what are the old Macs? Sonos, Intel, Pepsi, Barbie, all the fun stuff. I don't know if you can see because it's so bright.
I can see it. I think that's an Apple computer somewhere over there, right?
It is. I'll walk you guys over.
Yeah. So there is Apple computer from the days, was that the Macintosh? Yeah, I remember that.
It is from 1984.
Yeah, that's awesome.
Tesla Cybertruck, some really, just to show the audience, some really cool artifacts from our NASDAQ 100 companies. Here's an old Texas Instrument calculator.
That's awesome.
Microsoft, this is from 1995, Windows 95.
Yeah.
Mike, I don't know if you remember when we get the CDs to download.
Yeah, I remember them. Yes, I remember AOL took the scene when they sent everybody in pretty much the world a CD that they installed AOL.
Yes.
Right? But unfortunately, I think AOL was listed on the New York Stock Exchange, but I do remember the Microsoft 1994. But really, I mean, what floor? I know that we've been there before. It's the new lobby on the 4th floor of the NASDAQ market site, right?
Yep, second floor. Yep.
Second floor. I was saying, my bad. Well, anyway, let's jump right in. We had some interesting news today. When you see a head like this, you start to wonder, will the asset managers strike back? Passive investing has now topped actively managed assets in stocks. That means that people are just putting their money into ETFs. They are putting their money into these kind of exchange traded funds. And as you can see, just under that headline, it says the 10-year yield climbs to 4.15 on a strong jobs data as NASDAQ stocks rise, led by Apple, which briefly erased the 2024 losses. So we're basically back in positive territory as of today. So your thoughts, is there some trouble on the horizon when we start to see that passive investing has now exceeded actively managed funds on Wall Street?
You know, it's so interesting, Mike. I'm surprised to see that headline, and I'm sure they have the data to support it, but a lot of the reporting that we've been doing, and of course, we're getting ready for our presence at Exchange ETFs in Miami, February 12th and 13th. We'll be on the ground live there. That active management, particularly in the fixed income space, and more of the alternative ETFs, if you will, those are pretty actively managed. I'm surprised to see a headline like that where they're talking about passive and being benched to the indexes. Anecdotally, what we've been reporting on and covering has really been more from the active management perspective. Certainly on the fixed income side, as fixed income has somewhat come back into favor, it's a little bit of a challenge for managers. When you're benched to the S&P, you're benched to the Qs, to the NASDAQ 100 because of the presence of the Mag 7. If you had exposure to them last year, that was great. If you have exposure to them in a time where they're all trading in tandem to the downside, you don't want to only be reliant on 7 stocks to make or break your year. And there are a number of other alternatives that are out there that are quietly returned really well last year. So I guess the long story short, too long didn't read, on the fixed income side, certainly seeing more active.
Without a doubt. I mean, there's massive advantages to fixed income active management, wide spreads, really accessibility.
Right. I mean, the bond market is just a different animal than the fixed income market. It is incredibly difficult for a number of reasons for a retail investor to replicate a bond fund not even due to prices, but just the complexity of building a fixed income ETF. It would just be too expensive to do it on your own.
Without a doubt. So, I mean, that brings me to the next, point and fact that I wanted to just point out. We had a big gap up. Today's headline was very good news for Apple. We had an Apple upgrade. It's also very good news for the economy overall, that the economy seems to continually, the consumer is continuing to do well. We are here in earnings season in January. But it's kind of, we're in this spot that, good news for the economy might be bad news for rate cuts. We had one of the Fed governors come out today saying that they're expecting rate cuts by the third quarter of 2024. But at the same time, the 10-year today was moving to the upside, because good economic news does not necessarily mean that the Fed is going to cut rates. They're more inclined to raise rates. And if the economy is doing good, then people are still spending, then you might see a return to inflation. So what are your thoughts on this kind of dichotomy that we have going on?
So we've been covering this extensively, as has everyone on the street, and we're
Ad
back in that.
nauseum. That's almost
Good news for the economy is bad news for the market. And there's a couple of things here. I think, at the end of last year, everything was moving higher. Multiple markets priced in a Goldilocks scenario as when it comes to the Fed. If the economy is doing well, consumer, retail spend has been strong, labor market remains strong. You are seeing deflation in certain areas of the economy. They're not going to cut if the economy doesn't need help, because should inflation insert itself again, you're going to need, the Fed's going to need tools to be able to tame that. And if they go too low, they're going to run out of those tools. That's one thing. I do not think we're going to get 6 rate cuts this year. Certainly not, it'll be 25 basis points if they occur at all. 6 rate cuts. I mean, we're nearing February already, and we're thinking about March. I'd be surprised if they would be that aggressive. And I think, the Fed was right in telegraphing this in 2023, that they were going to be very deliberate. They weren't going to make swift rate changes, so we don't make the mistakes of the 70s and 80s. So when they, are coming out, we had Governor Waller, we had another one speaking today, that it's not a policy that's going to be rushed. This isn't different than the messaging that they've delivered all year. Even when they said we're starting rate cuts at 2024, it doesn't mean that we're going to go back to, 2-3%. That's not going to happen. So I think the markets, not just the equity market, overshot themselves. And, there, in addition to that, there are a number of other geopolitical issues that we did not have in the beginning of last year. I mean, not the amount that we're having. You have supply chain challenges. Should this, what's happening with the major trading routes, should this get prolonged? So, I know the market climbed a wall of worry in 2023, but I feel like between the UK, US election, the multiple areas of conflict that we're in, and with this trading route issue that we're now dealing with, any one of these
basically is, and the Red Sea is pretty much a war zone, basically.
Yeah, we're dealing with a lot on multiple fronts. Hey.
Yeah. No, there's definitely a lot going on in the wall of worry, and certainly I think that they said that, I think there were some reports out of Davos, which is actually going on right now, the World Economic Forum, that potentially a Trump victory would not be a terrible thing for the economy, or at least that was one of the reports that was out today. The fact is that any U.S. election is a massive amount of uncertainty. A U.S. presidential election, this one is by far probably the largest one for concern. So that is something that is definitely going to weigh on the market. It certainly doesn't seem to be weighing on the market today, though, because we gapped up, we did fade, but then certainly we have continued to move higher as the day has gone by. I mean, there was the gap up, there was the gap fade, and then sure enough, you can see it so far we've been put in a very big green bar from a technicals perspective, shown here on my Dash Trader charts. Let's jump ahead and talk a little bit about earnings season. I do have the chart of JP Morgan, which is the first of the big banks that came out. They actually had decent earnings, although their profits were down pretty considerably. What have you seen so far? What are the early indications from this earnings season. What are the earnings results for 2023?
Yeah, I mean, to your point, it's still a little bit early because really just the asset managers and the banks have reported. I think, but what you can extrapolate from this, investment banking revenue was the lowest that it's been since 2012. Not a surprise. There's no deal activity. IPOs were slow last year. We're certainly off to a slow start this year. And I think we're in a wait and see mode. There, to what we're talking about before in the last slide, there are a number of outliers there. Interest rates remain a concern, and with the election, with geopolitics, with the strength of the economy, perhaps companies should be more wait and see, right? So I think if we were to see IPO activity pick up, M&A activity pick up, not only is that what the investment banks need and want, but that also is a sign of confidence in the economy and the market. So I think there's a lot to be seen there. It feels as if, and this is the vibe sitting at an exchange, things are picking up. There's more interest, let's put it like that. Lifting back behind the curtain, we're seeing more companies visit. We're seeing, the tours around the exchange being given. I don't recall this happening at this time last year, and certainly not over the summer. So that, anecdotally, it's building up a little, from the guys on our markets intelligence desk and all the guests that we have on the show and through the exchange, Q3 and forward back half of the year sounds, more promising as there's more clarity, with, the outliers that we're contending with, but, it does feel like things are picking up. Healthcare and tech seem to be the two sectors where we're going to see that, particularly in the med tech space. And that's really like the intel that we've been picking up on. But I think not only would this be good for the banks, but I think it's also a sign of how investors are perceiving the economy, Fed policy, the markets.
Makes sense. I mean, I know that last year, 2023, was a particularly bad year for IPOs and for new offerings and really M&A activity. Very, very dismal year for sure. And also we're starting to see some layoffs, this year in the tech space, which is kind of conflicting because, we keep getting these numbers out of companies like Apple that things are great and that they're being upgraded. But again, that also sometimes layoffs are considered a positive things for companies as they are cutting their cost, and labor is one of the biggest costs. So we are seeing some, maybe that's tech tightening of belts, preparing for a potential slowdown. What are your thoughts on that?
It's so interesting when you get these layoff announcements. Clearly, the stock reacts positively to it, to your point, labor being your biggest cost. But then you have to think about it from the, economic perspective. If you start to get in the hundreds of thousands of layoffs occurring, then you have a larger macro problem than you do the price of a stock and a single company strategy. Because layoffs, unless it's an isolated strategy issue, tend to permeate throughout sectors, right? So for example, if investment banks, if they're struggling at one bank with no deal flow, well, they're struggling at other banks. So that's a larger macro issue. And I think that's really what we need to discern here to see, is this company specific? We kind of went through a number of layoffs after tech companies right-sized following pandemic hiring. Mm-hmm. And that was a tech industry thing. It wasn't like it was specific to Meta or Google or, one company. It wasn't a strategy flaw. It was an industry overhire. So I think that's really what we need to wait and see. But Mike, the old adage, if your neighbor loses their job, it's a recession. If you lose your job, it's a depression. So
that's exactly right. That's 100% right. Yeah.
I think you told me that actually. Yeah.
Absolutely. Very good point. Well, Jill, listen, I want you to have a great weekend, and I look forward to seeing you in 2 weeks.
All right. Sounds good. Take care, Mike. Take care, guys.
Thank you so much for your analysis, as always.
You got it.
We're going to jump to the market analysis. Let's jump right into the charts. I'm just going to transfer my screen real quick, and then we're going to look at where the market is at. I mean, the markets are just on fire. I mean, you could see the time and sale. I have the S&P up here, right here. This is my 5-minute chart on the S&P. Today is 118, Thursday, right before the close at 353. And you can see that the market, I'm just going to bring up my daily chart. the market has been making higher highs, well, actually equal highs. So we have one equal high, another equal high. We've been making higher lows, which would be considered fairly bullish to be making higher lows, even if you're making, that would be like a ascending triangle. But the question is whether or not the market breaks out here, whether it breaks out to a new high. The S&P is the broader index. The volume is off slightly. Generally speaking, I'm going to take a look at some of the banks today. JP Morgan down on its earnings. Let's just see, BAC down on earnings. We're going to look at Citibank. Citibank had abysmal earnings. I mean, their earnings were terrible. They took a big, huge write-off. So Citibank also down. So usually you'll look at the financial sector to see if the health of the financial sector is what facilitates the health of the overall market. So you can't really have a continuation of a rally. Let's see, Goldman Sachs, not terrible, but certainly kind of flattish. If Goldman Sachs kind of breaks down, it could go either way here based off the chart. Morgan Stanley, not looking good at all for Morgan Stanley. So we're really showing some weakness overall from the early results from the financial sector. But, you know, when you go to technology, you get a completely different story. I mean, Apple, big, huge gap up today, breaking the midpoint of the W and really rallying to its point of control based on the price on volume that's listed on my chart. We also have, let's take a look at MSFT, which is Microsoft. Microsoft is now the biggest stock by market cap in the world. Basically, Microsoft having a bull pennant and then breaking out to the upside and now going into what looks like all-time highs. On Microsoft. Microsoft has done tremendously well on everything related to the cloud space and to AI as well. Let's take a look at NVIDIA, NVDA. NVIDIA also here all the way at all-time highs at 570. So, I mean, you're seeing a lot of strength in technology, but you could also say that potentially things are a little bit overdone. So we will see how earnings season goes for technology, but thus far, the financials have not done well post earnings. So the initial earnings was kind of mixed, but then the couple of days since then has been kind of bearish and or negative. The other thing I want to take a look at is GBTC, because there was some big news out of Bitcoin that the SEC is potentially allowing for more ETFs in the cryptocurrency space. Now, the reason I think this is important for GBTC is because it was basically the only show in town. It is not a traditional ETF, and here it rallied to an all-time high just recently. And then sure enough, now that they're going to be facing some heightened competition, it looks like things are selling off. Now, obviously, Bitcoin and cryptocurrency, which they hold a tremendous amount of, since they are basically the only ETF in the Bitcoin and cryptocurrency space, that has run tremendously up into this announcement, and you kind of buy the rumor, sell the news. So here that's being indicated in the chart, as we can see here. Big time pickup in volume. A big pickup in volume of that like that is usually indicative of a reversal. One more thing I want to take a look at is GLD, because gold tends to do well going into February. It goes into the Lunar, the Lunar New Year, which is celebrated through most of Asia, and usually gold will run into and top out into February, which is what we're just about getting into now. So definitely keep an eye on gold. But of course, if the dollar gets stronger, then gold gets weaker. Gold gets weaker, dollar gets stronger. So there's usually an inverse relationship with the old man GLD. So certainly another thing to take a look at. Now, the last but not least is oil. So USO, we have a kind of looking like oil prices might be coming to the upside. Now, we've had incredibly cold weather here in the Northeast. So with incredibly cold weather in the Northeast and around the country, you tend to get an increase in oil. Oil is the prime commodity. Prime commodity usually means that you will, see that cost increase pass through to all the other stocks in the in the market. Everything requires oil to get to its final destination. So therefore, if oil prices start to go up, you'll probably see a resurgence of inflation. So let's jump back and wrap things up. All right. Stay up to date with all things DAS by signing up to our monthly newsletter and email. Simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel at Dash Trader TV and the DAS Newsroom Reminders. Certainly follow us on social media if you haven't already done so at LinkedIn, Twitter, Facebook, and Instagram. And just a reminder that we have another number one trader competition coming up, number one best trader competition coming up in March. So stay tuned for the updates. There will be some exceptional opportunities to participate in this number one best trader competition sponsored by Cobra Trading. Look forward to seeing you there, and I'll see you in 2 weeks. Have a wonderful weekend, everybody. Trade well.